For many homeowners, their houses are not only a place of refuge from all sorts of storms, but also a safe space for their life savings. But what if I told you that your home might lose half its value in a matter of days, leaving you underwater on your mortgage and unable to sell? That's not a hypothetical scenario. That's the reality that millions of Americans are staring at. They just don't know when it will strike. This year will likely witness the worst housing crash in history, blowing the 2007-2008 crisis out of the water. It will wipe out trillions of dollars of wealth and plunge the economy into a deep recession. But let's pause momentarily and ask ourselves why anyone would have such a gloomy view of the housing market. Well, the easiest answer is that the United States housing market is coming off a bubble, and as usual, when a bubble pops, it hurts many homeowners because the prices rarely go back to what they were before. If you think I'm just another YouTuber making noise about a housing bubble, listen to what the Federal Bank of Dallas said in a report released in early 2022. Our evidence points to abnormal U.S. housing market behavior for the first time since the boom of the early 2000s. Reasons for concern are clear in certain economic indicators. The price-to-rent ratio in particular, and the price-to-income ratio, which shows signs that 2021 house prices appear increasingly out of step with fundamentals. Ladies and gentlemen, the exuberance witnessed in the housing market during the pandemic was an inflating bubble that reached critical levels in 2022, and the time is now ripe for a massive explosion. This video will explore how the U.S. housing market found itself in the current mess. We will also explore the factors conspiring to crash the market, leaving home prices in a hole they may never climb out of. So prepare yourself for an exhilarating experience, and while you're at it, please support our channel with a thumbs up and don't forget to subscribe. Also, I advise you to let this video run to the end because I will be sharing gems to help you protect your hard-earned money from the imminent crash. How did we get here? The median home prices have posted an improbable winning streak, only resting twice, January 2021 and January 2022, before rising to the highest peak in history in August 2022. For context on how ridiculous the peak is, the Zillow Home Value Index was $180,438 in February 2015 and $347,272 in August 2022, a nearly 93% price hike in 7 years. Interestingly, there was strong opposition to the argument that the housing market was in a bubble even as prices shot up relentlessly. For instance, Carl Smith of the Niskanen Center, a leading public policy think tank, posted in 2017 that instead of thinking about the rising asset prices in the housing market as a bubble, we should see a massive increase in liquidity occasioned by the financial innovation, including the Fed's quantitative easing measures in the late 1990s and early 2000s. That increase in liquidity, Smith argued, allowed real estate markets to behave more like stock or commodity markets. In good times, prices would rise rapidly as money poured into capital markets. During recessions, prices would retreat as money retreated to safer havens. 5 years later, Smith's view was the majority. In May 2022, Business Insider surveyed 32 real estate experts seeking their insights on the situation in the housing market. Specifically, the researchers wanted expert opinions on whether the housing market was in a bubble. And interestingly, nearly 70% of respondents said that although the eye test indicated a bubble, the U.S. housing market was nowhere near a bubble. Some proponents of the narrative that the housing market was not in a recession, such as Ivy Zelman, CEO of Zelman & Associates, premised their argument on the fact that there was a tremendous number of constraints on curing the low inventory problem in the market. But evidence on the ground told a different story. For example, a real estate agent who spoke to The Guardian said she started noticing some anomalies in the housing market in 2021. Sasha Davis, the realtor mentioned, said she wrote 50 offers for clients looking to purchase a home in Florida, but only 5 succeeded, a miserable acceptance rate suggesting an unfavorable buyer's market. As per Davis, listings that would normally attract 5 offers were getting between 50 and 100. Interestingly, some of her clients made cash offers that exceeded the list price but were not enough to get them a house. But as Zillow Home Value Index shows, this was a national trend. In the 2 years between September 2020 and September 2022, the index rose nearly 37%, indicating signs of abnormal activity. In this light, the Dallas Fed explored whether the abnormal activity in the housing market pointed to a bubble. Between early 2020 and August 2022, median house prices grew exponentially, exceeding what economic fundamentals would justify. The Dallas Fed has a name for this phenomenon: Exuberance. In fact, the Fed's exuberance indicator revealed that the U.S. housing market exhibited all indications of exuberance for over 5 consecutive quarters through the third quarter of 2021. This extended to the second quarter of 2022, but while the prices corrected slightly in the second quarter of 2022, a massive crash did not come, making the majority of the market, both the demand and supply side, complacent until now. A crash is imminent. It will change the housing landscape forever. You see, people have been told since the fourth quarter of 2017 that the housing market is on the verge of a crash. The warning bells intensified their tolling when the coronavirus pandemic befell us. An economic recession was expected to be inevitable, which would force a correction of prices in over-leveraged markets, the housing market not spared. But the pandemic did its stint and fizzled out without scratching the market. In fact, the extra liquidity the government injected into the economy as a strategy to shield consumers added more fuel to the fire. But backpedal with me for a second and consider the argument by Ivy Zelman, CEO of Zelman & Associates. If you may recall, she was one of the majority voices that said the U.S. housing market was not in recession, according to the Business Insider survey. Also remember that the core of her argument was that there was no way the market could solve the supply problem, which was the only sure way to trigger a massive rebalancing of the market from seller's favorite to buyer's favorite. Many real estate experts held and still hold this view. In this light, I posit that we are in the last peaceful moments of the housing market for 2 primary reasons. First, the Dallas Fed's study presents irrefutable evidence confirming the U.S. housing market bubble. Experts like Zelman may want to disagree with the data because exuberance has them blinded. But this type of exuberance is what one economist called irrational. A Nobel Prize-winning economist, Robert Shiller, wrote that irrational exuberance is widespread and undue economic optimism that lacks a real foundation of fundamental valuation, but instead rests on psychological factors. Unfortunately, this phenomenon is one of the primary factors that crystallized the mortgage-backed security crisis that spawned the 2007-2008 financial crisis. Once again, we are in a situation where nothing can sum it up better than the saying, "Fool me once, shame on you. Fool me twice, shame on me." Stress signs are already showing, and unsurprisingly, the Florida market has a front seat to the show. According to CoreLogic's U.S. home price insights for June 2023, home price growth slowed to single digit in April compared to a record high of nearly 20% in spring 2022. The primary reason for the slowing price growth, the report says, is buyer reluctance driven by numerous economic concerns, including mortgage rate volatility. This is what CoreLogic's chief economist had to say about the buyer reluctance. While mortgage rate volatility continues to cause buyer hesitation, the lack of for-sale homes is putting firm pressure on prices this spring, leading to above-average seasonal monthly gains and a rebound in home prices in most markets. Nevertheless, the recent surge in mortgage rates and continued inflation issues suggest that rates may remain elevated, leading home price appreciation to possibly relax this summer and return to average seasonal gains later in 2023. Furthermore, the monthly update of CoreLogic market risk indicators shows that on the top 5 markets likely to witness a significant home price decline, 4 are in Florida, including Lakeland, Winter Haven, Northport, Sarasota, Bradenton, Cape Coral, Fort Myers, and Port St. Lucie. Like the literal bubble, Florida is the small area of weakness needed to generate a massive explosion. The second reason home prices will never be the same is declining institutional buyer activity. Institutional buyers are an important component of the housing market. In 2021, they accounted for 15% of residential purchases. National Association of Realtors data shows, interestingly, the median purchase price of institutional buyers is typically 26% lower than the state's median purchase prices, meaning they can acquire a huge number of housing units. Simply put, institutional buyers play a huge role in home price inflation, but recent data shows this category of buyers is slowing down on purchases. For example, Yield Street official, Yield Street is one of the biggest institutional buyers in the market, told Fortune that the company had reduced buying levels by 90%. Home Partners of America is also walking a similar path. Add to this fact that the short-term rental market is going through a shakeup, which might see plenty of housing units dumped in the broader housing market. Once these factors coverage and register their full force, we will likely see the largest housing correction since the Second World War. Home prices will plummet, and it may be decades before they recover to familiar territory. Unfortunately, no one will escape the adverse effects of such a development, but count yourself lucky because here are some strategies you can employ to stay safe. Here are some tips on how to protect yourself from a housing market crash. Diversify your portfolio by investing in different asset classes such as stocks, bonds, cash, commercial real estate, precious metals, and alternative investments. Avoid over-leveraging, which may leave you vulnerable in case the inevitable happens. Adopt a long-term investment mindset. If you're a homeowner, try not to panic during short-term market fluctuations. Real estate is typically a long-term investment, and historical trends indicate that property values tend to rise over time despite occasional downturns. Stay informed and seek professional advice. Keep yourself updated on economic news, market trends, and expert opinions. Consult with financial advisors, real estate professionals, or economists who can provide valuable insights specific to your situation. Thanks for watching. Please like, subscribe, and comment below, and watch this one as well.